Audio Jungle. Audio Jungle.
Central clearing party stands in the middle. So the central clearing party is taking the risk. Essentially, after it's been presented to a central clearing party, company A has a transaction with a CCP and company B has a transaction with a CCP. Sound familiar? Of course, it's exactly the way futures markets work. If you do a futures trade on the floor, electronically, you don't have to worry about the counterparty because you're not really transacting with that counterparty. You're transacting with the exchange clearinghouse. So similar sort of idea. So here's a little picture I use a lot. So let's suppose, we start off, we've got 8 market participants. They are trading with each other and they're clearing their transactions bilaterally. That means they've got agreements with each other for clearing the transactions. So lots and lots of agreements. These are called master agreements. The ISDA master agreement, of course, is a common one. And one key feature of those master agreements is netting. That all the transactions I ever do with you, as a result of this master agreement, we're going to net against each other. So if you default, it's basically the net value of the transactions that determines how much I owe you or you owe me. You can't cherry pick which transactions you will default on. And they're also netted as far as any collateral agreements are concerned. So so you can see there's lots of different bilateral master agreements there. And then we move, let's suppose, unrealistically, of course, that every transaction moves to a CCP. Then these 8 market participants are all then trading with a CCP. Much more netting, because if you had transactions with counterparty A and then transactions with counterparty B, previously you would have 2 master agreements and you couldn't net those transactions off against each other. But once you've moved to this world, the transactions do get netted off against each other. Of course, this isn't actually, it isn't the case that everything has moved from this world to that world. What's happened is that standard transactions, which are mostly interest rate swaps and credit derivatives that depend on indices, standard transactions have now to be cleared through CCPs if they're between financial institutions or systemically important players in the market. So large proportion of those transactions, I say the interest rate derivatives and the index credit derivatives, the rules say they've got to go through CCPs. But non-standard transactions will continue to be cleared bilaterally. And the other thing that's been misleading about this diagram in a way is, of course, there's not one CCP. There's quite a number of different CCPs. So you don't get the full benefits of netting if some of your transactions have gone through LCH ClearNet and some have gone through CME Group, because they won't be netted off against each other. So, well, just before we leave this, let me say that pre-crisis, CCPs have existed for quite a while. Pre-crisis, about 25% of over-the-counter derivatives went through CCPs. Post-crisis, it's 75%, round figures. So, big effect in terms of how things are cleared and how they're handled. Now, what about the transactions that don't go through CCPs? Derivative traders are if there's an advantage to not going through CCPs, derivative traders are quite capable of adding some bells and whistles to a transaction to make them non-standard so that the rules don't apply. But what the new rules say, and these were rules that were agreed at G20 meetings in 2011, is that non-standard, or sometimes called uncleared derivatives, when they're between financial institutions or other systemically important companies, you have to post both initial margin and variation margin. These are rules which are coming in between 2016 and 2020. So sort of, for very large financial institutions, they're coming in 2016, and then, as you move down to smaller financial institutions, it's later. And if you are a relatively small player in derivatives markets, the rules won't apply to you. But the way they work is that you have to exchange initial margin. So you revalue the transactions. These are the uncleared transactions, the ones that don't go through CCPs. You value them every day. Transactions I have with you would be valued every day. And if the transactions have moved $5 million in your favor, I have to provide you with an extra $5 million of collateral. If it's the other way around, you have to provide me with $5 million of collateral. That's the variation margin that is exchanged, sort of just representing the change in value of the transaction. And then there's initial margin, which has to be posted with a third party. It wouldn't make any sense for me to provide you with, shall we say, $10 million of initial margin and you to provide me with $10 million of initial margin. That would just be a wash. So the initial margin has to be posted with a third party. And that gives rise to the complication of how do we calculate initial margin. And there's been a few developments recently as far as this is concerned. Obviously, I mean, the whole industry has to agree on some procedure for calculating initial margin. It's no good if I'm JP Morgan and I'm calculating initial margin this way and you're Goldman Sachs and you're calculating initial margin some totally different way. We're never going to be able to transact the uncleared stuff with each other. The Basel Committee proposed what's known as a grid approach for calculating initial margin, but that wasn't very popular with the industry because it didn't allow netting. So if I did a transaction with you today and then 1 week later we do an almost opposite transaction, then there shouldn't be too much initial margin for that because they kind of offset each other almost completely. But as far as the grid approach is concerned, no, there's no netting. So you just have twice as much initial margin, which of course isn't very popular. So the industry the industry body has come up with an alternative standard, which is known as SIM, Standard Initial Margin Model, which does allow netting and takes correlations into account, and it's based on Greek letters, basically. And, the industry appears to have reached agreement on this, zeroed in on it, so it's a case, and the regulators have agreed that it's okay. So the key point about initial margin, obviously the CCPs, for the stuff that's cleared, the CCPs require initial margin. And, in round figures, the CCPs will use 99% confidence, 5-day time horizon in calculating initial margin. For the uncleared stuff, of course, the uncleared stuff is not as liquid as the cleared stuff. So if somebody defaults, it's going to take longer to unwind the position. So typically for the uncleared stuff, it's 10 days, 99% confidence that is used as the criteria. One question I'm asked a lot, in fact, I think we had a discussion about this at this conference last year, is too big to fail. Have we really achieved anything with all of this? Because, it used to be the case that because of its big derivatives position and so on, JP Morgan was too big to fail because, there'd be a ripple effect through the economy. Now, it's not JP Morgan so much that's too big to fail, it's LCH ClearNet, the big CCP in London, England, that's too big to fail. And so we've not really achieved anything. We've just moved the too big to fail financial institutions from the banks to the CCPs. Well, it's certainly true that LCH ClearNet is too big to fail. It would be a disaster if LCH ClearNet failed, or CME Group or any of the other big CCPs. But I would argue that yes, we have achieved something, because a CCP such as LCH ClearNet is doing something pretty simple. It is acting as an intermediary in over-the-counter transactions. It's got a few key decisions to make, like who do we admit as a member? How do we calculate initial margin? How do we calculate default fund contributions? All of those sort of things. So I would argue that it's relatively easy to regulate a CCP because a CCP is doing something very simple. It's almost impossible to regulate JP Morgan because it's a big opaque bank, very difficult for regulators to get a handle on what it's doing. So I would say that whereas JP Morgan was almost impossible to regulate, LCH ClearNet should be possible to regulate. I understand they've got about 100 regulators in London, England, keeping an eye on what LCH ClearNet is doing. But, I think one of the things about this is that we have to be careful that these CCPs are utilities. Like utilities, and they only do one thing, and hopefully do it well. I mean, we don't want, LCH ClearNet to have its own trading operation, become, speculator, and so on. And we don't want to see too much, say, competition between CCPs on reducing initial margin. The regulators have got to keep an eye on that. But so long as we do all that, I think it should be easier to make sure that we don't get a failure of a CCP than a failure of a large bank. So what have we got as a result of the derivative changes? We've got more post-trade transparency. We've got all these trade repositories, more collateral and capital. You could say that there's more netting in the system now because of the CCPs, as I was indicating earlier, that there's more, in principle, you can net more transactions against each other, but on the other hand, there's more initial margin as well. And I think the extra initial margin, the impact of that on collateral increasing is greater than the impact of the extra netting on collateral decreasing. More capital, as we've said. I think the big trend, is that the OTC markets are becoming more like the exchange-traded markets. That, because what are we seeing? We're seeing that the standard OTC derivatives have got to be traded on electronic platforms. Yeah, sounds very much like exchanges. They've got to be cleared through CCPs. CCPs are very much like exchange clearing houses. And prices have got to be reported. So I think we're seeing a sort of convergence, if you like, of the two types of markets. And maybe sort of 10, 15 years down the road, it might be very difficult to actually, say when you do a particular transaction, was that an OTC transaction or exchange-traded transaction? CME Group handled it, I don't know, could have been either. So there's less exotics being traded because extra capital requirements, and you've got all this business of the uncleared stuff and the extra initial margin. The 10 days, 99% instead of the 5 days, 99% initial margin. And what we saw for a while anyways was that the CFTC, the regulatory body in the US, was attempting to trade swaps like futures, which was, in my opinion, a big mistake. CFTC traditionally has been in charge of trading futures, and naturally when they were given responsibility for trading swaps and having these platforms for trading swaps, they said, well, we can trade swaps like futures. And I don't think that we can, because swaps are fundamentally different from futures. Futures are trading all the time in small amounts. Swaps are trading intermittently, large notional principles. They're quite different products, and you think you need a different type of trading platform, and I think that's now being realized. But for a while, swap trading was moving to Europe because the US regulators were handling it so badly. So, in the interest of time, I won't say a lot about this slide, but we've got, of course, other regulations which we're seeing in various parts of the world. So, clamping down on proprietary trading in particular, more capital for systemically important financial institutions, fundamental review of the trading book, which I'm going to be talking about later on today, and other people at this conference as well. We're seeing the emergence of shadow banking and the importance of technology. Difficult problem for the regulators because, they're regulating banks, but then there's all these shadow banks, listing some of them here, that are kind of doing bank-like things. They're taking deposits and making loans. But they may not call themselves banks, and they're under the radar as far as bank regulation is concerned. So I think that's one problem as far as regulation is concerned. The other is, the whole pace of technology change, which, say, we're wrestling with at Rotman in terms of how we teach this to our students, but, payment systems, wealth management, peer-to-peer lending, huge changes taking place, and those, again, at some stage are going to attract the attention of regulators. And then we've got Trump. Difficult to have any conversation today without talking about Trump. You may remember Trump, soon after he was elected, said he was going to do, or maybe before, I can't remember, said he was going to do a number on Dodd-Frank. A number on Dodd-Frank, which the House Committee on Financial Services in the US has recently passed the Financial Choice Act, which would get rid of the Volcker Rule. Now, this is only the House Committee that's passed it, but if it's passed by the Senate and signed by Trump, then the Volcker Rule is gone. The Volcker Rule is the thing that prevents banks from doing proprietary trading. And, the other, so, that could well disappear. That's probably the most likely thing that to happen as a result of Trump's sort of anti-regulation bias. Consumer Protection, Financial Protection Bureau, which very unpopular with banks, although it does a lot of interesting stuff, could disappear. Trump has indicated that he's not that comfortable cooperating with international agencies. It is possible, the US doesn't always toe the line totally as far as the Basel Committee is concerned, but that could become more pronounced. But, for example, FRTB, which, as I say, I'm going to be talking about today and others are going to be talking about, That's very complex, unpopular regulation for market risk, determining market risk capital. It's conceivable the US could say, FRTB doesn't apply to US banks. We're not going to implement it. And in fact, some of the major US banks have put their FRTB implementations on hold because they're not sure how the world's going to evolve. One of the good things from Trump, I think, from my perspective anyway, is that the new CFTC head is a Republican, of course, and he actually has a background in over-the-counter derivative trading. He understands swaps markets. So some of these problems of trying to treat swaps like futures will hopefully disappear. And I think, there's two aspects of what Trump's going to do. I mean, one is, will he throw out some of the regulations? And the other is, will he implement the regulations that are left as stringently as they have been in the past? And both of those will probably happen. I mean, things like CCAR, for example, the stress testing, that could be watered down quite a bit under Trump. So my conclusions. I think you'll see from what I've presented that the OTC market is becoming a lot more like the exchange-traded market. And I expect that trend to continue. I think equity capital requirements for banks, will increase. Actually, they have increased. That's should change the verb there. I mentioned the 14%, the 14% return on equity, which banks had pre-crisis, going to 2% unless they do something. And banks, of course, are doing things to increase their margins and so on, and it's costing us, as the consumers of bank products, money. Liquidity, I think, will become progressively more important as a currency for decisions. Say, it used to be regulatory capital, which was the currency. How do we allocate regulatory capital? But now we have to worry about how we allocate liquidity as well. And technology changes and shadow banking are, of course, becoming important. So thank you. Maybe have we got time for one or two questions, if there are any? Or
I'd just like to ask you a question about where does IFRS 9 and SECL fit into all this scheme?
IFRS 9 and?
SECL.
Yeah, IFRS 9 is basically saying that traditionally we haven't revalued revalued loans. Basically, loans are held at historical cost, and IFRS 9 is moving banks away from that and saying that what you've got to do is to estimate your expected losses on your loan portfolio and subtract expected losses from what you post the value of the loans on your books as. And one question, so IFRS 9, it is, as you can imagine, I have a number of interesting sort of thoughts on IFRS 9, but it's creating a huge amount of work for banks because they have to estimate expected losses on their loan portfolio. And then there's the question of over what period of time do you estimate losses? Is it over the next 12 months, or is it over the whole, if I've got a 5-year mortgage, for example, do I estimate losses over 5 years over the next 12 months? And there's FASB and the IFRS 9 people disagree on that. The US regulators wants to do it over the whole life of the loan, whereas IFRS 9 is 12 months in the first instance, but if problems arise, then we'll we'll look over the whole life of the loan. So in many ways, the US regulation is more logical to my mind. But yeah, no, another aspect of this, which may, may interest some of the more technically minded of you, is that IFRS 9, what they say is that you should estimate losses on the loans. There's this business in credit risk of whether we use the real world or the risk-neutral world. If we can use the real world, look at historical data, say, on average, we lose 0.5% a year on this, on this loan portfolio. Or we can use the risk-neutral world, and we can say, let's look at credit spreads and estimate loss probabilities from credit spreads. And the second number is much bigger than the first number. So you say, well, which one should we use when implementing IFRS 9? And I would argue that you should use credit spreads, and you should use risk-neutral estimates because this is a valuation exercise. You're revaluing the loan portfolio. And when it's a valuation exercise, you should use risk-neutral probabilities. When it's just a scenario analysis, just how bad could things get 1 year, 2 years down the road, then it's the real world. And I've discussed this quite a bit with accountants, and they kind of agree with me theoretically, but in practice, they're going to use real world estimates, not risk-neutral estimates. So yeah, I mean, there's, it's, I don't know that it ties in exactly with these other regulations that I've been talking about in any sort of very direct way, but it's certainly, IFRS 9 is causing a lot of grief for banks. Any other questions or comments?
John? John?
Mm-hmm.
I have a question.
Sorry, I can't, the light's in my eyes, I can't see.
No, I'm right in front of you, but on your left side.
Okay, yes?
Yes.
Yes, one of my academic colleagues. Yeah,
Yes.
I always expected they had a very difficult question.
This question actually
Yeah.
is, it's more like something, I really enjoyed the CCP description. I think it was very clear, and the boundaries, the different boundaries between what's cleared, not cleared, and so forth, and the issue of too big to fail. And I think that you drew I want you to comment on this. I don't want to make a long question, but the question of too big to fail for CCPs has been a dilemma of the regulatory community and even the academic community. But it seems that I think you hinted at the solution, seriously, because what happens with banks, regulators, it would be crazy if we said, okay, we need an institution to give credit, so we only have one bank. Then you have a problem, because the bank automatically becomes too big to fail, and automatically you have trouble in case you burn through the bank reserves. I believe that this is the same in some respect, despite the fact that you have a guarantee fund for the CCPs. So what I think the solution, and I want you to comment on this, is to demand that there be no monopoly in CCP on a jurisdiction. That is, that at least we have 2 CCPs, so we can use a device that central banks use when a bank fails, which is to port the assets, to create sort of a $1 sale and port the assets to the second CCP.
So you're saying that we should have, in any jurisdiction, 2 CCPs?
2 CCPs, and try to have the less interoperability between them, or monitor people who clear in both places, because if one CCP goes belly up, then immediately you can take all the accounts, port them to the second CCP, and use a guarantee fund to produce a smooth transition, in case of a failure of a CCP, which I think is, what do you think about that?
Well, no, I think that's an interesting idea. Another idea, which I wrote an article for Journal of Derivatives about this, is that actually if you just change the contract which the CCP has with its members, you can pretty much solve the problem as well, because if I go bankrupt, I'm a CCP member, I go bankrupt, you have to unwind my transactions, right? Now, by definition, let's suppose I have a swap where I'm paying fixed. there must be some other member of the CCP who's got a swap where they're receiving fixed, right? There's got to be. So we could have a rule that says there will be this process for choosing the other members that will close out positions, and they will close out the positions according to the following rules. And yes, they may make a loss doing that, but that's part of their contract with us. So, that's something that's kind of not written into the rules of the CCP membership, but it kind of is expected that the other members will help out in terms of closing out positions. And I think if you made it a rigorous requirement of the CCP, then we could say, there's a limit to how badly things could go wrong. What the CCPs are required by regulators to do right now is to imagine the situation where their two biggest members fail at the same time and see if they would survive. That's one of the tests they put them through. But your idea is another interesting one as well. Maybe, guess you all want to get ready for the workshops now.
Damas y caballeros, les pido un caluroso aplauso para Mr. John Hong. John, thank you very much.
Thank you.
Audio Jungle.